Welcome to Fatratkiller's weekly crypto alpha. Let's cut through the noise.
25 engineers quit Zcash on January 7th. The entire core team. 9 years of work, one board meeting, gone. The token crashed 48%. The protocol kept running. Nobody was left to maintain it. The blockchain didn't care. 48 hours later, ZAMA, the leading FHE project, pushed their token auction from January 12th to January 21st. No explanation. Same week ZEC collapsed. They bought themselves 9 extra days. By Friday, FHE tokens were up 89%. Capital didn't leave privacy. It changed languages.
This is the first strange thing. Here's the second.
A payment standard called ERC 8004 processed 60 million transactions last month. For context, Visa handles 150 million daily. This network, serving customers that aren't human, hit 40% of Visa's volume in its first real month. Nobody on crypto Twitter mentioned it. Not once in the top 100 threads. Not in any major newsletter. 60 million transactions. Invisible. Third strange thing, the wallet 0x7a3 F91 accumulated 98 million tokens of a protocol called Rails at 26 cents average. This happened while JP Morgan announced their integration. The wallet hasn't sold? Not one token.
There's a pattern here. Let me show you what connects them.
Our models flagged January 7th and 8th as statistical anomalies. Information volume hit 5.8 standard deviations above normal. That's not a spike. That's a scream. We traced what triggered it. 2 parallel narratives collided. Narrative 1, Zeki's governance war. The Bootstrap board blocked the team from privatizing their wallet product. The team wanted to spin out, raise VC, move fast. The board said no. 501, C3 rules. Fiduciary duty. Potential lawsuits. The team chose exit over stagnation. Narrative 2, ERC 8004's quiet rise. AI agents learning to pay each other. No human wallets. No API middlemen. Machine-to-machine settlement in 2 seconds. 0.5% cost.
These aren't separate stories. Watch the capital flow.
Monday, ZEC engineering team resigns. Tuesday, ZEC drops from $501 to $395. Wednesday, FHE-related tokens see $47 million in net inflows. Thursday, ZAMA delays auction. Friday, Virtual's ecosystem up 66%. X402 volume up 750% week over week. Saturday, Zk founder tweets, "We're fine." The money knew before the tweets. Now here's what almost nobody tracked. Dexter, the protocol that facilitates X402 payments, held 100% market share 6 months ago. Today, 40 to 50%. The obvious read is failure. The correct read is validation. When a category goes from 1 player to 5 in 6 months, that's not fragmentation. That's product market fit being confirmed by competition. Pay AI emerged on Base. Hey Elsa integrated with Virtuals. Daydreams ate share on Solana. The pie grew faster than Dexter's slice shrank.
Same pattern happened in DEXs in 2020. Uniswap went from 100% to 60%. Everyone called it failure. The category became a $1 trillion market.
But there's a darker layer to the DEX comparison. We found something in the Solana data that should concern you. Jito, the leading landing service for Solana transactions, processes 80 million transactions per week. That's 93.5% of all successful transaction routing. Near monopoly. Here's how it works. Users pay priority fees that go to validators, plus tips that go to Jito. Jito then splits those tips with the apps that routed you to them. Translation: the app you used to trade took a cut of your guaranteed success fee. You paid extra because you feared failure. They pocketed the margin.
The data shows low-activity wallets, retail, pay dramatically higher fees per transaction than high-frequency wallets. The system extracts more from people who understand it least.
This isn't a bug. It's the business model. Hyperliquid runs its own chain. No landing services, no tip splitting. The fee is the fee. Their market share in perpetual DEX went from 30% to 70 to 80% in 12 months. Retail figured it out. Now let me show you the calendar that matters. January 16th, ERC 8004 mainnet. The standard goes live. Every AI agent protocol that's been testing X402 will have infrastructure to build on. This is TCP/IP day for machine payments. January 17th, $23.8 billion in deribit options expire. Bitcoin and Ethereum. The largest options expiry since March 2024. Volatility clusters around these dates, not because of the expiry itself, but because of the positioning games leading up to it. January 21st, 3 unlocks hit simultaneously. Plume, 39.75% afloat. 4 of every 10 tokens that exist become sellable. SKR, 3 billion tokens to 150,000 Solana phone owners. Average holder paid $450 for hardware. Expect immediate selling. Ondo, 1.9 billion tokens. $860 million at current prices. Same day, ZAMA auction opens. FHE's price discovery event, happening during maximum chaos. This isn't coincidence. This is game theory.
ZAMA pushed their auction into the unlock bloodbath. Why? Because desperate sellers create cheap prices. Because attention is divided. Because anyone watching unlocks isn't watching auctions.
They're buying their token at a discount. Through timing. One more anomaly you should know about. We track sentiment polarity across all on-chain data sources. Bullish language versus bearish language, scored daily. January 9th was the only negative day this week. Net sentiment -3. The ZEC collapse had contagion fear spreading. By January 11th, +27, the highest reading of the month. The market processed a decade-old project's implosion and repriced the replacement narrative in 48 hours. That's not irrational exuberance. That's efficient repricing. The capital already knew where it was going.
Here's what this means mechanically.
We ran hypothesis tests on leader versus follower returns in each sector. In most sectors, perp dexes, RWA protocols, no significant difference. Rising tide, all boats. 2 sectors showed statistical significance at p less than 0.01. Agent payment protocols. Leaders up 66.2%, followers up 23.4%. FHE infrastructure. Leaders up 47.1%, followers down 12.3%. The gap isn't marginal. It's structural. In these categories specifically, picking the leader matters more than picking the category.
Don't spray across the sector. Pick.
Now, the hidden signal that has zero Twitter presence. MediaTek manufactures chips for 40% of Android phones. 2 billion devices. They announced Solana integration, hardware-level wallet infrastructure built into the chip. Separately, Xiaomi pre-installing SEI wallets across 20,000 retail stores in Asia. SEI just became the #1 EVM chain by wallet count. Not through DeFi yields, through distribution. Neither of these has a tradable token tied directly to the catalyst. There's no MediaTek coin. There's no Xiaomi chain. So the trade is second order. Which protocols benefit when 2 billion devices can interact with crypto without downloading anything? This takes 18 months to deploy. By the time it's visible in prices, the positioning window closed.
The entropy score for mobile distribution infrastructure was plus 215%, highest of any sector. The attention is crystallizing. The tokens are unclear.
One final phenomenon. GenLayer launched something called a synthetic jurisdiction, AI validators running optimistic democracy consensus for contract disputes. The concept, when AI agents transact at machine speed, human courts can't adjudicate disputes economically. A $50 disagreement can't survive a $10,000 legal process. GenLayer's solution. AI judges, on-chain rules, 10% daily withdrawal limits as a safety rail. Mainnet Alpha deployed in December. ETH USDC live. This sounds like science fiction. It's running code. Traditional dispute resolution costs $500 to $50,000 per case. GenLayer's target, under $1. If agent commerce scales, this becomes mandatory infrastructure.
The question isn't whether it works. The question is whether anyone else ships it before they do.
January 21st sits 9 days away. 3 billion tokens hit the market. $1 billion auction opens. Options expire. Narrative shifts. Some will catch falling knives. Some will find the entries they waited 6 months for. The Zkey engineers scattered. Somewhere, they're probably building the thing that replaces what they left. The only trace they leave is a wallet pattern we'll recognize too late. Follow me on X at Fatratkiller for more alpha that satisfies your intellectual appetite. See you next week.